Just to go through some highlights for the year, as we said previously, we've been focusing quite a lot on our cloud partners and making sure that we have a lockstep movement with them in terms of where they are physically located in the year. The first half of FY18, ending December, we concentrated on adding those locations, and we've added over 46 cloud on-ramp locations globally to have the highest number of any SDN or any fabric provider today globally, with 108 cloud on-ramps, and also access to the cloud regions at 62. So it's 74% increase year on year on cloud on-ramps. And that's important for two reasons. One, it gives us access to the cloud providers for customers closer and closer to where the customers exist today. In other words, we're getting deeper and deeper into where they are, not in the physical locations where the cloud on-ramps tend to be traditionally. So that's given us access into more markets and more customers and reach. At the same time, during FY18, we added two more major cloud providers to our infrastructure, IBM Cloud and Salesforce. And we're also expanding our Megaport marketplace, our Megaport exchange, with over 300 service providers, of which the cloud providers are there. And as you recall, back in March, April, we completed a 60 million capital raising, a strategic capital raising, and the remaining 27 was the fallover between last year's period, June and July, where we had the 27 million between the two periods. The key call out from this, from a financial results point of view, is the achievement of a huge milestone, which is the profit after direct network costs, or the equivalent of our gross margin, for want of a better word, where we went from a loss the previous year of 0.6 million in FY17 to add 5.1 million, that to bring it into a profit of 4.5 million. So this is the first real milestone from a financial perspective, as well as growing revenue, but it gets us over that gross profit position globally for a business. And the overall margin in FY18 at about 23% blended. Some KPIs from FY18. We've added data centers. We're at 221 at the end of June. Today, as we were here, we're at 229. We have ports added to the network, 2,755. The number of services has more than doubled, just under double at 6,500. Again, referencing more and more consumption of services that customer has. So this is the ecosystem where we have one port or two ports, but I'm able to access multiple services from that port globally. So again, services and ports are both revenue billing events and create revenue. So the more services that are consumed, the more revenue you can generate for the business. Total customers increased by 300 to 1,038. We hit our 1,000 customer back, I think, in the 5th of June in one of our locations in Denver. And it's over 1,100 customers today as we're here, and our monthly recurring revenue is at 2 million for the end of June, up 63% from the previous period. Overall annualized revenue on a run rate of 24 million. In terms of the business units and a breakdown of where the revenue is coming from, we're seeing each of the three business units of the regions contributing nicely to the overall total revenue. Starting with Asia Pacific, had a really good year, 66% growth in revenue, up from 5.1 to 8.4 million for the year. Our North America business, going from a base of 1.3, added 4.1 million to 5.4 million. And then our European business from 4.3 up 39% to 6 million overall, giving us 19.8 million for the full year, up 85%, or up 9.1 million for the 12 months. Quick look at the financial results. This morning we released on the ASX the full annual report and financial statements for anybody who wants to get into the detail, but next couple of slides are just summaries. Consolidated profit and loss, as I mentioned, revenue is 19.8 million, up 85%. Direct network costs, or the profit after direct network costs, as I mentioned, is improved by 5.1 million to a profit of 4.5 for the year. And our operating expenses are up 3 million. Normalized EBITDA is at 22.1 of a loss versus 23.7, so an improvement of 7% there. And overall net loss for the year was 24.5 million compared to a loss of 29.9, so an improvement there, 5.5 million in the year. Just looking at the regional breakdown of the revenue, as you can, and probably if we were to look at FY16, you probably recall that nearly 90% of our revenue is coming from the APAC region. Now accounts for 43% of our revenue, with between 27 and 30% coming from both North America and Europe. So we're seeing a lot more of a a neutral spread of our revenue, and we expect the North America component going from 12% last year up to 27% this year to increase even further and have a larger concentration of the revenue coming from North America in FY19. Overall revenue up 85%, as I mentioned, and monthly recurring revenue up 63% for the period. In terms of the operating costs, our direct network costs, which effectively is where we connect data centers together and are upgrading our overall network, increased from 11.2 million to 15.2, up by 3 million. Bearing in mind we added 56 new data center locations and upgraded our North American network to 100 gig. So while we're investing in that, and that's pretty much 40 of those 56 locations were in the US, so we're in 101 of the 225 locations in the US. So again, re-emphasizing the investment in the US market while we're continuing to grow the business there, at the same time doubling down in that space. Overall, as I mentioned, the profit at 4.5 for the year. Employee costs are up from 15.6 to 19.6. That's our largest investment, again reflecting on our sales and marketing teams and on our technical teams as we grow the business, and obviously 14 countries across 3 continents to allow us to actually access customers and serve them, which we'll talk a little bit more in the presentation. Our other operating cost categories all reduced year on year, just continuing the impact as we scale the business. Overall OPEX was up 3 million for the period. In terms of the balance sheet and the financial positions, as we mentioned earlier on, we had the major strategic investment come on board in March, April. We added 60 million, and we had the early part of July, we had the tail of the previous one from the end of last year. Significantly strengthens the balance sheet overall. Closing cash at the end of the period was 56 million. And then the investment in the network and in our non-current assets really is reflective of the footprint, the equipment that we've installed across the network, and the upgrade in the network itself to serve our customers, which is the underlying physical infrastructure that we have. Just a little bit about Megaport in general. I want to talk about the industry, and again, just as an update and what we've talked about 6 months ago, but again, it's relevant. The latest Gartner report on cloud activity is $186 billion industry we're in, forecasted to continue to grow. This is the industry that we're in. The top 7 providers that we have connected on our ecosystem account for 70% of the market share on that graph of 186 billion today. So that's the space we're in, and it's forecasted over the next 4 or 5 years to continue to grow. The graph on the table on your right, which talks about the Cisco Cloud Index, which talks about the amount of data that's actually being pushed into the public cloud arena from today, has grown from, or forecasting to grow from 6 zettabytes, which is some ridiculous amount of bytes. But it's forecasted to treble to 18 billion over the next couple of years. So again, not only are cloud service providers forecasting that they're going to have a lot more revenue and a lot more activity in the industry, the amount of data that's going to move from physical infrastructure, or even just in general, the amount of data that's going to be consumed going forward is going to quadruple or triple, and actually a lot of that is going to reside in 1 or 2 of the public cloud providers today. And I suppose lastly on this slide, and it really kind of makes us as a business feel a little bit more significant in the overall scheme of things, is that our own trends and our own data that we're able to quote from now is that we're seeing that because of our ecosystem, because we've got so many providers on things, we're seeing on our own growth over the last 12 months that customers are connecting to more than one cloud provider, i.e. multiple cloud, and that's grown by over 208% today. I'll talk a little bit later about that in a slide or two in terms of our overall traffic profile and what our customers are doing. But that really makes it important for us, because if you've got a one-stop shop and you've got an ecosystem and you've got all the providers connecting on it, it makes it easier for the customer to connect and consume the cloud. And that speeds up adoption, but it also speeds up for us the access to more and more services across our ecosystem. So again, we've seen that like 208% increase over this year. Megaport Cloud Router has an impact on that as well. And as we continue to enable that capability going forward, the whole idea is to drive more and more services given what we've already built today and the ecosystem that we've got with the partners. Quick touch on network as a service. I mean, this is really our value proposition. As we said before, AWS, 10 years ago, effectively virtualized cloud compute or virtualized compute and storage by selling that and be able to pay for it as you go. We've done the same thing for networking. We've virtualized how you can connect in the same manner that you consume cloud, pay for what you use, how you can actually decide what capacity you want, right size it. You can switch it and make it flexible. You've got choice, multiple providers, multiple applications and storage and compute that you want to use and how you want to use it. It means the customer has the choice, and they're actually able to do it much quicker and speed up the connectivity. And that's really important for us as a business. It's a foundation. Nobody today is replicating this. And that's what's really important. And the fact that we've been on the road on this since IPO nearly 3 years, and we're still the only ones doing this. And I think that's a testament to the fact that this is not easy to do, and the fact that we've done it early in place, so it's very hard to catch up on it. Again, what are we trying to do? We're ultimately trying to connect everyone to everything. We internally had our own mission statement, which is pretty much around revolutionizing connectivity. I mean, that's really what we're trying to do. We're trying to connect as many things as possible so customers and consumers can consume as many things as they can easily. And that's negating the whole networking problem that's out there today. Multiple vendors, multiple ways of connecting, and having to deal with that headache. We've got over 1,000 customers today, as I mentioned, and they reside in multiple countries, multiple locations, geographic locations. They reside in 68 different types of data center providers that are on our ecosystem today. And they're coming on and using our ecosystem because the value proposition of ease of use, ease of consumption. I don't have to build networks to where all the cloud is. Megaport brings the cloud to me. And that's what's happening. And that's why you see on the ecosystem on the right-hand side, we have over 300 service providers and the cloud providers. We're joining the dots between the cloud providers and where the customers exist today in the world. And this is something we're going to continue to do going forward. Megaport Cloud Router, again, a really important product launch for us during the last, I suppose, end of January when we launched it. It's effectively continuing on from the virtualization of the network that I talked about. Megaport Cloud Router is a virtual router. It allows us to dynamically, I suppose, enable IP traffic control across our software domain. In other words, we're able to divert traffic where we need to go to get its end destination. It opens up many user cases for us, and the most prominent one, coming back to multi-cloud, is the ability to log into AWS, where you may have your data stored, and move that data across to Oracle, where maybe your financial services exist, or maybe you want to move it across to Google's applications because you want to do some AI, some sort of business intelligence or on the data. So this allows the seamless connectivity of data to move seamlessly across cloud environments. And you may ask, why is that important? Well, it's important for our business because it drives another level of service activity. So we can charge for that, right? So this is a customer moving virtual data across the network using our ecosystem, and we can charge for that. And it drives the usage, or more importantly, drives the number of services that the customer can use from their port on Megaport. So that's the importance of our product, and we're going to continue to invest in that. In Megaport Cloud Router and other capabilities that we have around that will bring in more user cases, again, making the customer sticky. Once they're on the fabric and they're using it, what else can they use it for? Okay. In terms of business update, quickly spin through some of this. It's just a graphic showing the quarter-on-quarter growth. On the bottom, you can see the ports in the gray, and on the blue on top, you can see the amount of services. Services are now outstripping the growth rate of ports, which again reflects that the customer has a port, and from that port, they can actually consume multiple services. Our monthly recurring revenue up 63% based on both billable events of, one, a customer coming onto the network, and B, using the network. The data centers, as I mentioned, increased 34% up to 221. We're at 229 for this so far here in the middle of August. The forecast and the plan is to do 300 by the end of June 19. As we run through, I'll talk a little bit later on that. Customers, as I said, grew by 300 up to 1,038. We're already over 1,100 as we see here today, up 41% for the period. Ports up 51%, but more importantly, the growth in services up 74%, which again just drives the utilization of our ecosystem and customers using more and more services. Average revenue per port is $720, up $53 or 8% on the period. So not only are we getting an uplift in volume and transactions connecting on a network, we're also getting an uplift in spend. Again, referring back to the spirograph that we keep showing, Again, we're just showing it over the last 3 periods ending June. You can see the density on the top right-hand corner, the density of the ports on the outer ring that are on our network. You can see the lines that traverse across those are all the virtual connections across our network. More importantly, down in the bottom right-hand corner in the pie chart, 58% of all of our connections across our network are connecting to a cloud provider. It's far outstripped, as you can see, the evolution of connectivity over the 3 graphs. It's becoming the #1 user case for customers to use it. And more importantly, as I said earlier, on the 208% growth we've seen in multi-cloud. So it's not just accessing Azure or AWS, it's actually accessing more than 1 or 2 of those cloud providers so they can build their IT infrastructure and cloud and data management around that. Okay, so I'm going to spend a little bit of time on this graph. This is pretty much new information, and I know Nick mentioned it at the top of the call. Starting on the left-hand side, as you look at it, this is a breakdown of our customer cohort. So think of this as what's the life cycle of a customer like when we started this business 4 years ago, and what does that customer look like today compared to what does new customers coming on the network look like today and how they behave. Starting with the bottom left-hand corner, I know that little small dot there you see in the bottom left-hand corner is FY14 customers that joined our network in 2014, that period, and they were consuming an average of 2.3 services per customer. As you move up that axis and into year 2, 3, 4, and 5, that same cohort of customers are now consuming 11.1 services per customer. So what that means is that as they've moved up, they're actually consuming more services. They've got more comfortable with it. There's a lot more education around the market. There's a lot more ease of use and connecting and actually the ability to connect to more services. As we move across on the bottom right into FY15, that next set of customers are already in their first year consuming more services than the previous year. They're at 3.3. FY16, 17, and 18 are on average 4 services. So when they start, they're actually using 4 services at the beginning. But what's really interesting is as they move up in their next evolution of their year 2 and their year 3 in their life cycle, they're now spending up to 13, 10, as you can see in 7.6. They're actually doubling up on the amount of services each year they stay on the Megaport ecosystem. And why is that important? It's important because we're actually giving them a choice. We're actually educating them, the cloud adoption in general, both from the cloud providers, educating the market, making their applications, making, once you're in the cloud, easier to consume. The fact that the networking component matches that and makes that in, it means it's easier for consuming. And probably the easiest way I've explained this, if you remember back when the mobile phones all came out, when you started out with the phone, and when data came out, you got free data, and it was easy to go onto Facebook, it was easy to go onto consumption, and after a while, it was a drug. You were on it, and you were hooked on it, and you just consume more and more data. The same thing happens with ecosystem. Once you're on it, and you're using it, and it's ease of use, oh, I can use Google, oh, I can use AWS, and so IT people get comfortable and they start consuming more. And that's the journey that we're seeing here as customers move along and as they go to maturity with our product. If you look at the right-hand side chart, again, it's reflecting the same journey, only this time we're talking about the revenue or the amount of money the customers are spending with Megaport in each one of those years. Starting with FY14 in the bottom corner here, as we look at it here, $433 starting out, that first set of customers using 2.3 services. And as you look up along the axis, they're now spending $2,303 over that after 5 years, that same cohort of customers. But as you move across the axis on the bottom, customers that joined us in this financial year ending FY18 are already spending $1,249 in their first year. So again, we're getting not only usage of services, but actually spending money with the company. And even though our blended stats, which are in the chart on the right-hand side, even though our blended stats say average customers are spending 6.3 services, you can see from the chart, 6.3 is very much a blended number, but you can see the maturity of customers and where they are in the life cycle. As they move along, they spend a lot more than the average, right? The same can be said on the consumption services as the dollar value. Leading on from that, just to go back and have a look at what does it look like with Australia versus the US in terms of the Australia customers for over 5 years, and how does that look like versus the first 2 years of our US business and what the customers are doing there. In the grey bar that you see on the left-hand side, which is the average services per the Australian customer, has grown from the initial 1 down at the very bottom left-hand corner right up to an average, I think, 6.9 in year 5, and that's a blended number for the entire Australian base. But you can see on the blue chart that's overlaid on it that our US customers, even in their year 1 and year 2, are already using more services than our Australian customer. It could be for many reasons, could be education, et cetera, but a lot of this is actually access and ease of use to services. Same thing on the chart on the right. When you look at the Australia customer and what they're spending per customer, you can see it there as they move across to an average around $1,500 overall by year 5, but we're already up over at the $1,500 and $2,000 mark in the US customers. So they're spending more in general than our Australia customers already. 2 things about both of these sets of slides, in particular this one. We have been talking about this since IPO, the importance of investing in the US market. It's not a small place. We know that. There's a lot of cities, it's a big country, and there's a lot of customers there, and we're trying to make sure that we're in as many of those locations as possible to build a pervasive network so that over the next 3 to 5 years we've got a sustainable business that in basically is the only standard de facto way of connecting to cloud service providers going forward. In terms of, very quickly, just a regional breakdown on our business units. We talked about the revenue overall at the beginning, but just some KPIs on our Asia Pacific business. Like I said at the beginning, we added 56 locations. 12 of those were in APAC. Some of them in Australia, some of them in Hong Kong and Singapore and New Zealand, majority of them in Australia. 59 data centers at the end of the year. Ports were at 1,355. And monthly recurring revenue nearly doubled from $500,000 to just short of $1 million at 900,000. So again, this market is really important. Not only is it embedded, I suppose, not only is the Australian market the key component of it, but we're starting to see our New Zealand market and Hong Kong and Singapore market bring, and particularly in Southeast Asia, bring more global customers to those markets that we've already got in other locations. Customers at 529, services 3676, and network profit after direct network cost 55%. And this entire region is EBITDA positive. Some stats on the right hand side. Average revenue per port is up, number of ports per data center is up, services per port, and actually the number of services per customer that we talked about in the previous charts, more importantly, is what drives that revenue, is up 22%. Switching to our North America business, like I said, of the 56 sites that we added, pretty much 39 of those went into the US, and we're at 100 today at the end of June. Ports nearly doubled at 812, revenue 300,000 up to $500,000. Customers more than doubled from 140 to 340. We've nearly had a tripling on the number of services from 800 up to over 2,000. And while we still have a loss here on direct network costs, notwithstanding the fact that we added nearly 40 sites in the investment in the network, we anticipate that this number will be positive over the next 12 months. Average revenue per port down slightly at 675. This is diluted by the fact that we've just added so many customers and services literally in the last half year. We expect that to rebound based on those customers coming to a full year of spend. Ports per data center up 39%, and service per port and service per customer up as well for the period. At 34% utilization here, we've got plenty of headroom in the locations that we've built into to sell more. Our European business, to round it out, we've added 5 data centers here in our European business. Ports are reasonably flat at 588, but revenue is up over nearly, as I said, over 33%, up to 400 to 600,000 monthly recurring revenue. Customers slightly up at 251, but the number of services up over 300, profit after direct network costs of 48%. And this one is probably only a quarter away from being EBITDA positive in total. Some interesting stats. The actual revenue per port has jumped up to $950, up 34% in the period. And also the number of services per port and the number of services per customer in double digits at 37 and 25%. Again, as the Megaport ecosystem comes into play, we move away from the original business that we bought, which was the IX on a one port, one service metric. So again, healthy to see that coming through, and the revenue per port at the same time. Just a quick snapshot on partners and customers. As I said earlier on, we've got 68 global data center providers or regional data center providers on our network, and this is just a sample of those that joined in 2018. We will continue to have a strong pipeline of data centers that are coming to us to bring the ecosystem in, and you'll see more of those come out in the news. You probably saw there's DataBank and some other ones that are not on here, which happened in July, and you'll see a few more of those come through in the next couple of periods. But again, deepening down with these partners in existing footprints and locations that they have, but also adding more data center providers. We are the only, when you stand back and you look at it, we're the only one fabric that connects so many competing businesses, if you want to call data centers competing businesses, together on one fabric that actually seamlessly connects them all to the cloud provider. So again, it's a very unique situation that we find ourselves in, but more importantly, we're seeing more and more data centers come to us to bring their ecosystem into their facilities. A snapshot on the cloud and our partners here, as I mentioned earlier on, up 74% in the cloud, and you can see there the number of regions, AWS and Microsoft, or sorry, the number of locations that we're in on the left-hand side. We continue to work in lockstep with our cloud providers to make sure not only as we move into new markets or new countries that we bring the cloud access to them, but also we actually make sure that we're bringing customers within the same region so they can access those cloud providers. And you can see the list there. We've up to 62 different cloud regions listed here as we move through each of the territories or each of the regions. And then the key customer wins. As I said, during this year, we added 300 customers globally and regionally. And here's just this, I see you guys got your logo up here.
Thank you.
Yeah, so key customer wins here. And so this is a snapshot of just a sample of some of those customers. But the one takeaway from it, or two takeaways from this slide, is that there's such a smattering of customers here from various different industries and verticals. The one thing that they all have common is they all need to get access to public cloud so they can use it and run their IT and infrastructure and data. So we're not limited to any one vertical or any one industry. We also have some, I suppose, network or managed service providers. We've got T-Systems here and Vodafone, NTT that we had on the previous slide, who use us as a partner, not only as a customer they're using our services, but actually they're actually selling our services to their customer. So effectively being a reseller. So it's a really, again, a really important set of customers that we have, and we want to keep going and making sure we bring as many customers on and logos on as we can over 2019. And pretty much I'm down to the second last slide. Just a quick snapshot. The chart obviously plots the locations, the physical locations over time, focusing on FY16, 17, 18. Since the IPO, you can see we've done a tremendous lot of investing in both the network, the material, our partners, our customers, and key milestones that we're in. This is to position the company for the next 2 or 3 years to make sure that we're in the right space. We're still today the only provider that can actually do what we're doing today. And so positioning ourselves and maintaining that position is incredibly important from a strategic point of view for our investment going forward into the next 5 and 10 years. So again, we're going to be extremely busy in FY19 and FY20. We're not slowing down. We're not taking our foot off the gas here. This is all in as far as we're concerned as a business. And then just winding it off is just really our focus for FY19. It's, I won't say more of the same, but it's more locations, more customers, more partners, new markets, new territories, existing markets, but also more importantly is the investment in not just Megaport Cloud Router, but the next wave of data interconnection services, again, to create more user cases and more cases where customers can actually, we can charge for customers consuming services as we, and again, leading global innovator and provider in this space, and obviously drive revenue growth, which is a key component of our financial model.